A very good afternoon, good morning. Welcome to HYCM's workshop with myself, Giles Cochran, Chief Currency Analyst. Good to see you. Hope everybody's doing well. Really looking forward to taking us through this session. I'm going to give us a good overview of what's happening in markets so you can see the big picture. I'm also going to be highlighting some opportunities that there are potentially in gold at the moment, as well as looking at the euro pound with the spring statement in the UK being released, as well as looking at the New Zealand dollar Japanese yen pair, and just be running through those potential opportunities. Now, don't forget, as we look at different instruments, different trading currencies, commodities, indices, the whole purpose of this webinar is a educational webinar that helps folks understand how someone like myself with a professional trading background understands financial markets, and hopefully that will improve decision-making processes. We're also going to look at the SNB rate meeting. Now, SNB are meeting tomorrow, and I'll just be sharing what we need to look for as they meet. And we're going to start with the SNB rate meeting, and I'm going to go over to my other screen so you can see exactly what's going on. Let's have a look. There we go. Right. Now, here I have the Euro Swiss franc. Now, a couple of things I want to just point out to you. Now, the Swiss National Bank really does not like a strong Swiss franc. Now, if you look at the Euro Swiss franc pair, you can see since the financial crisis of 2008, investors have been buying the Swiss franc in huge amounts. Now, the Swiss do not like this because this makes the Swiss franc very strong, and the Swiss have what's called an export economy. In other words, a lot of their economy is boosted by their export market. Now, when you have a strong domestic currency, it means that your domestic exports become more expensive overseas. So, of course, if you were an exporter in Switzerland, the last thing you want to see is a strong Swiss franc. Now, in 2012, for about 3 years, the Swiss National Bank said, right, we're fed up of this. We're not going to allow the Swiss franc to gain anymore, and we're going to deliberately peg this 1.2 level, okay? Now, that 1.2 level, they said that anytime price gets near it, we're going to defend it. And how do they defend it? Through FX interventions, which is when they actually buy euros and dollars to support the market. Now, you'll notice here this huge candlestick there. This is when the Swiss got into a problem because they realized they could no longer defend this region, but they weren't able to tell markets that gently. They just had to remove the peg, and there was this huge fall, about 40% drop in just minutes, and it was a massive problem for financial markets. Some hedge funds actually went bankrupt on this. Some brokers actually even went bankrupt on this. So all that is by way of saying that the Swiss do not like a strong Swiss franc. And look where the Swiss franc is now. It's strong. Now, you might think, okay, that means that the Swiss National Bank are going to automatically intervene in markets. Now, this is something I pointed out on my blog. Now, make sure you follow along on my blog. I'm just going to give you the link. So I'm just putting it in the chat box. I'll give you the link now to my blog. And in the blog, I look at the big meetings coming up. And one of the things I'm saying is look for comments on the real exchange rate. So the Swiss National Bank is focused on the real exchange rate rather than the nominal exchange rate. So what is that? Well, the real exchange rate allows for inflation. And when inflation is allowed for, the exchange rate is not so worrying for the Swiss. So they're not going to be massively automatically worried about this. And they're unlikely to hike interest rates before the ECB do. So probably no changes expected, but one thing to look out for is if they suddenly say that they're concerned about real exchange rates and the real exchange rate level is worrying them, then look for some immediate upside in euro Swiss franc. But the main issue with this is don't get sucked in thinking, oh yes, this is good value for the euro Swiss franc, because actually the euro Swiss franc pair can keep dropping lower. And if risk-off markets remain, remember the Swiss franc will continue to drop lower. And also remember that the Swiss franc is very closely correlated to gold. So if we see deflationary fears, if we see inflationary fears rather manifest, gold will rise and the Swiss franc will rise with it, because 70% of all gold exports come through Switzerland. 70% of all gold in the world, rather, is refined in Switzerland. So gold prices has a very strong correlation to the Swiss franc. Very strong correlation indeed. So that's what you have to really, really be aware of. Keep on top of that dynamic. Let me try and show you that here. You see, let's just add gold prices. And you can see that gold prices, if gold prices surge higher, that tends to be a lift. See that, the way it tracks the Swiss franc. Gold prices, I'll just put gold prices in there. Gold. You can see, so as gold rises, that boosts the Swiss franc. As gold falls, the Swiss franc weakens. So there's a close correlation between the two. It's not perfect, but it's still a close correlation. Now, so the key thing is just not to get sucked into thinking that can keep going. But if they're worried about nominal real rates, or they say they're going to step up intervention, then that's a tradable opportunity on a quick spike higher. So look out for that tomorrow. Not necessarily expecting much, but it could be good. Now, another tradable opportunity that we've got at the moment is the euro pound. Now, the Bank of England is having the spring statement out at the moment. And if they disappoint markets, so they're not as constructive as markets are thinking, then you can buy at market with stops just underneath that 0.8286, looking for a move back up to 8360. Okay, move back up to that 83550 region, stops just underneath 8280, looking for a move higher, and a swing trading opportunity is in place, potentially looking for a move higher above these highs. Now, why is that? Well, it's because there's a difference between the ECB and the Bank of England right now. The ECB are expected to hike interest rates potentially this year. They're going to end their asset purchase program in the third quarter. They are worried about rising inflation, and the euro and the pound are both equally hit by Russian-Ukraine risk. If you notice, since the Russian-Ukraine risk, notice how we saw the euro fall and the pound fall at the same time. So both of them are impacted in the same way. So the Bank of England met last week, and at their meeting, Bank of England's Cunliffe voted against an interest rate hike, and he said that he was worried about the cost of living and consumer confidence in the UK. So all of a sudden, the Bank of England has turned a little bit more dovish. So that means there is a euro pound upside bias that is currently in play right now. Okay, and that is a legitimate potential opportunity here, is looking to go long euro pound at market with stops just below that recent below that recent level. So traders could look to enter that, could look to enter potentially at market and looking for a move back up towards that 0.8360 region as a first port of call. And if you would like more information on the Bank of England turning dovish, you can just take a look here under my central bank watch And you can see the Bank of England's dovish hike from last week, and also the ECB interest rate hike. And you can see the divergence between the two, and you can see how I talk about BOE's Cunliffe and the consumer confidence falling. Okay, so you know, a key kind of move to be aware of at the moment. Now, another opportunity that we have in the markets at the moment is in China's 50 index. Now, it's worth just looking at here. It's worth looking at the dynamic going on. Now, what's going on here is that the outlook in China is very different to the rest of the world. So what's going on in China is we've seen a 40% fall in stocks since February last year. Is that a huge drop? Now, that drop has prompted the Chinese government to say they want to support and stabilize stock markets. It's also prompted the People's Bank of China to cut interest rates. So the People's Bank of China is on an interest rate cutting cycle. And that means conditions are better for Chinese companies. There's a lot of risk that is factored and a lot of bad news priced in now. Now you see this reversal hammer bar. This is got a long candle. It's got a bullish close, crucially within the body of the previous day candle and space on the left. Technically, that is setting up for a move and a retest up to 14,600. Also, a drop lower into that 1,300 region would be suitable for buying. So this is a very, very kind of strong buy signal technically, and fundamentally, it also makes sense. So looking at that pair, it does offer opportunities at market and stops just underneath that 12,200. First target is the 14,600 region. Now, other global stocks are not in the same position because other global stock markets have central banks hiking interest rates. And this week, we've seen a lot of dollar strength, and that dollar strength has been on the news that the Federal Reserve could be hiking interest rates as much as like 50 basis points at the next interest rate meeting. And the Fed are expected to hike interest rates 7 times this year. So that's very hawkish. Now, here's a key dynamic to be aware of. Interest rates and stocks can move higher together. Okay, that is not an impossible relationship to see. That is a very normal and an environment that is okay. But if interest rates move high too quickly, think about it. That means people's mortgages are more expensive. It means companies' debt is more expensive. So it means consumers have less money to spend. Businesses have less money to, it's harder to borrow money to expand. And lower return, lower income means with people spending less, profitability is hit for companies and so stocks fall. Now, what the Fed are saying is that, look, this is the US consumer data. It's good. They're saying, look, it's positive. We're growing. The US economy can manage. But not all the data is good. If you look at the University of Michigan sentiment, that's turning negative. And that's one of the first indicators to highlight a problem. Because this University of Michigan sentiment indicator is looking at what individual consumers are feeling, okay? So consumers are some of the first to feel the pinch in hard times because people come home, will we buy a fridge next year? Will we buy a new car? What kind of expenditure will we make? This is showing that they're starting to feel a little bit worried. Obviously, inflation is surging 8% in the US, and that could end up slowing growth. If that slows growth, then we could see stocks sell off rapidly from here. So that's why stocks, this is not a place to buy stocks. Personally, I've closed all my stock positions, apart from like longer, but way longer term stock positions I have. But I am happy to go in the China 50. I think that looks really attractive at the short term. So this is the kind of environment that investors are trying to work out whether we're in or not. So what people are feeling is that we're in this stagflation environment. Now, stagflation is when you get high inflation, yes, we're there, and low growth. Now, we're not necessarily there yet at the moment because the US is confident that it's still growing. So if we have high inflation and high growth, that still does support, a pro-cyclical reflation narrative. But if we start to see growth slow, then that's when you get a deeply attractive long in gold. So just looking at gold, this is the other market that I'm looking at, which is interestingly, technically, a very good point. But ideally, what we'd want to see here, and you can see here, these 10-year yields selling off. If 10-year yields sell off, that'll be a real upside for gold. That's what gold needs to see more upside, is 10-year yields selling off. And if 10-year yields sell off, this is like kind of growth expectations. In the yield curve, the longer end of the yield curve is more growth expectations. The shorter end of the yield curve, like your 2 years, are inflation expectations. And interest rate, not inflation expectations, so interest rate hike expectations. So if the Fed's expected to hike, you're going to see your 2-year yields surge higher, right? And that's what we're seeing with Fed's Daily, Mester, Bullard, Powell, all looking at a 50 basis point rate hike as a possibility. We've seen the short end rise. Now, we've also seen the long end of the yield curve rise as well, which is a bit of a surprise. Now, if you go back to 2018, what you see here is that we're in a very similar situation where the Fed was hiking interest rates just as growth was slowing, and then 10-year yields sold off very heavily. Now, if that repeated again now, if growth prospects start to slow, and if this perception by the Fed that the US economy is going to grow, if it starts to show signs of weakness, then we could expect 10-year yields to fall lower. And if 10-year yields fall lower, that will be a big catalyst for gold upside. Now, let me show you what is driving gold. Gold is really driven by the correlation of these things, real yields and the dollar. Now, if you just look at the moment for real yields, can you notice that when real yields fall, gold rises? When real yields fall, gold rises. Real yields fall, gold rises. There's nothing that pushes yields higher better than falling real yields. Now, you can see at the moment that real yields are rising. Now, if you want to see this for yourself, just go to tips and look at this trading view symbol, Amex tip. And what you'll see is that as this rises, that pressures gold to the downside. Now, gold's been pressured to the downside on these tips rising. Now, what is tips? All tips is your US 10-year yield minus inflation expectations. So with 10-year yields surging higher, which you can see here in the white, right? As 10-year yields are surged higher, that's brought up real yields. But, this looks very stretched. So personally, I've taken a view that I'm expecting real yields to drop lower. Now, this is just my personal opinion, and I'm not saying you should trade this, but you can see this surge in 10-year yields, I'm expecting this to at least a little bit of a pullback, a little bit of mean reversion. And looking at gold markets, if real yields drop, we know that boosts gold higher. Now, if you look at this technically, I can define and limit risk very easily. I've got a bullish hammer reversal bar, got space to the left, bullish close within the body of the previous day candle, potentially looking for a run higher from the nose to the next retest up to 1960. We've now got Harami inside bar, false break of a Harami inside bar. We're now getting more consolidatory action. Price can be entered at market, stops underneath 1890, looking for a retest back up to 2050. So the risk reward is pretty good. You've got a risk reward of around 1 to 3, which is a very, very nice risk reward kind of position. You can see here, you've got your stops just there, and we've got your target heading up to sort of 2050. So you're risking, a 3.75 risk reward ratio. It makes a lot of sense from a risk reward perspective. Now, I don't always trade using the risk reward perspective, but it's good. Now, the weakness with the trade, of course, would be if the 10-year yields keep moving higher. So if these 10-year yields keep moving higher, then gold can keep moving lower. But notice this. You see, like, with the 10-year yields moving higher, you would have expected gold to have moved lower a lot more pronounced, and it didn't. So there's a saying in Wall Street: if something can't sell off on bad news, it can't sell off at all. So I think gold structurally makes sense. Personally, this is a trade I'm in on my personal account. Okay, looking for this potentially to continue moving higher. Oil markets are of interest at the moment. Notice oil volatility is really high. Remember what's going on here with oil. It's the Russian-Ukraine crisis, and particularly what's boosting oil at the moment is concerns that the EU might have an oil embargo. Now, two things to notice. You see, when volatility trends higher, usually that results in a downside for a commodity. This is different at the moment, but trending volatility is meaning that oil markets can have strong gains or falls, so watch out for that. But if the EU announce an oil embargo tomorrow, that will send oil even higher, because it means the EU will have to pay a premium for their oil. They don't necessarily have an obvious supply to replace EU or Russian oil, and it will mean just prices will keep going up and up and up. So watch out for that in terms of oil. We've got some inventory data out later, unlikely to move markets very much at all. Other key pairs to be looking at are the New Zealand dollar yen and Aussie yen pair. So if you look at the New Zealand dollar yen, it's absolutely surged high. Now, that's made sense with the bond yield spread between the New Zealand 10-year and the Japanese 10-year yield. Now, for those of you who realize, Japan are keeping their bond yield at like 0.00%. So if you just look at bonds, and if you just look here at Japanese bonds, do you notice how a Japanese bond is around this 0% region? What they say, the Bank of Japan, is they want to keep it in between the plus 0.25 and minus 0.25 region and keep it like at 0%. That keeps interest rate expectations low. Inflation in Japan is only 0.9%. In the US, it's over 8%, it's over 6% in the UK. So Japanese inflation is low. They're keeping the bond yield capped. And look at the yields in like New Zealand, 3.36, Canada, 2.39, Australia, 2.72, US, 2.37, but Japan, 0.22, so a very low yield. And they buy bonds to keep it at that price. So that means that structurally, the Bank of Japan has continued reasons for weakness. So that's why the New Zealand dollar has soared higher against. I was buying in from these bottom levels, and those of you who have been following, be aware, talking about this opportunity. So I took profit up at these highs around this 82.20, 82.19.20 region, roughly. I can't remember exactly, but anyway, took profit just up in these highs here. And any retracement lower, you can expect dip buys. This is not one to buy, but look, the bond yield spread still surging higher. Any retracement lower, back down to 82.50, can be considered suitable for dip buying at the moment. So that is an opportunity that we have in the markets. Australian dollar Japanese, very similar outlook. You know, expect dip buyers from any retracement back down to say like this 87.50 region. So got 1, 2, that's close enough. Yeah, so any retracement back down to 87 would be suitable for the Aussie dollar yen, and a very similar outlook. Now, the one risk you've got to look out for with the yen is this. Now, I'll explain to you what weakens the yen. Now, you can see how weak the yen has been like over the last few weeks and months. Look how weak it is, right? Weak, weak, weak. High oil prices really weaken the yen. Can you see when oil prices rise, yen weakens? When oil prices fall, yen strengthens. When oil prices rise, right? You can see here, rising oil, falling yen. Rising oil, falling yen. So high oil prices have also helped to keep yen weaker. So if there's suddenly like a Russian-Ukraine peace treaty, then you can expect yen to snap, to retrace pretty quickly. If nothing, and you might think, well, why is that? That's because Japan is a net importer of energy. If they want to use energy, they've got to import it. So when oil prices are high, it means their import costs for energy increase. Right? And they're also very, very weak right now. So be careful of chasing this move. It's not unreasonable to see some kind of retracement coming up at some point. Okay, folks, I hope some of that's helped. I hope that really you know, keeps you in tune with the markets. If you've got any other questions, please do ask any questions that you have, and I'm happy to help out in any way that I can. Don't forget to follow along my Twitter handle. If you're not already following me on Twitter, you can follow me here, and I'm just going to give my Twitter handle here. You can follow me there at Giles Cochran CCA, and I'll just check if anyone's got any questions. Oh, no, you're very welcome. I hope that presentation was helpful. Thanks, everyone. Now, take care, and don't forget, I am back here, scheduled back here on Monday. We will look at the week ahead, and next week we've got some growth indicators for the US, particularly non-farm payroll. So that will be indicative and interesting for next week. Thanks, everyone. Now, take care and goodbye.